All right, let's dive in. The crypto world has been buzzing again, hasn't it?
Oh, definitely.
And this time, well, it's not just the usual market swings. Bitcoin's creator, Satoshi Nakamoto, is back in the headlines in a huge way.
Absolutely. And it's not about someone claiming to be Satoshi. It's about the sheer scale of their estimated wealth.
Yeah, the numbers are just staggering. Sources are talking about Satoshi likely holding around, what, 1.96 million Bitcoin?
That's the figure most analyses point to, yeah. Around 1.96 million BTC.
And with Bitcoin's price recently, soaring, it hit nearly $112,000 for a bit, trading around $109,000 now.
Right.
That puts Satoshi's fortune at something like $120 billion.
$120 billion. It's quite the number.
It really is. Just incredible.
And that valuation, it doesn't just make them wealthy in crypto terms. It puts Satoshi, this anonymous person or group, onto the global rich list.
I saw that. Like 11th richest person globally, maybe even 10th.
Depending on the list you check, yeah. Placing them ahead of huge names like Bill Gates.
It's just mind-blowing. This unknown entity, potentially one of the richest people on Earth from something they created and then, well, seemingly just walked away from.
Exactly.
But, while that story itself is fascinating, this deep dive isn't only about one person's massive fortune.
Right.
This news is almost like a trigger point.
Yeah.
It gets you thinking about the bigger picture. What does wealth distribution actually look like across cryptocurrencies?
That's precisely the core of what we want to unpack today. We're
Yeah.
taking the Satoshi news and combining it with some really interesting academic research you found that digs into crypto wealth distribution.
Okay.
So the mission here is to use both these sources to first understand Satoshi's situation, then explore how wealth is spread out or concentrated in different cryptos using the insights from that paper.
And compare it to traditional economies.
Yes, compare it to traditional economies, and importantly, try to figure out what factors might be driving these patterns and, what it all means, the implications.
Okay, sounds good. Let's start with that $120 billion mystery, then Satoshi Nakamoto's fortune. That 1.96 million Bitcoin figure seems pretty solid.
It's the most widely cited number, yeah. Often based on analyzing those really early mine blocks. Some estimates do vary a bit. You might see ranges like 1.1 to 2 million BTC, but the general consensus is a very substantial hoard linked to Satoshi.
And the $120 billion valuation as of, late May 2025, that's purely because Bitcoin's price shot up recently.
Purely a function of that price rally, a fortune built entirely on the success of the network that kicked off.
Right. And it's that value that puts them up there with the global financial titans.
Mm-hmm.
And the mystery around who they actually are. Hal Finney, Nick Scigalbo, a whole group.
Yeah.
It just adds this layer of, myth to it all.
It really does.
What I find really striking, though, from a market angle is what analytics firms keep saying. Like Arkham Intelligence.
Yeah.
They confirm that the addresses tied to Satoshi's early mining, they're just dormant, haven't moved.
That's right. Those coins haven't moved since around 2011.
Wow.
And that dormancy is, it's crucial. It means those holdings, roughly 5.2% of all Bitcoin that will ever exist, are effectively not part of the circulating supply.
So they're kind of locked away, influencing the scarcity?
Exactly. It's been a constant factor. Yeah. And the potential impact if those coins ever did move, that's always a big what if in the market.
Yeah, I bet. It sort of represents this foundational concentration, even if it's passive.
Mm-hmm.
Meanwhile, the rest of the Bitcoin market has been hitting these huge milestones, like surpassing Amazon's market cap, $2.17 trillion.
It's been gaining serious traction, fueled by more institutions getting involved.
Right. You see firms like Strategy Now and Semler Scientific putting Bitcoin on their books.
Plus the spot Bitcoin ETFs making it easier for traditional investors to get in.
Yeah, it all adds up.
And just to put Satoshi's wealth in perspective again, one source did a fun hypothetical. For Satoshi to overtake Elon Musk, who's estimated around $395.6 billion Bitcoin, would need to hit about $360,000 per coin.
Wow. Okay, so even $120 billion has a ways to go to catch the very top. Puts it in perspective.
It does.
All right, so Satoshi's huge, untouched fortune definitely highlights massive wealth concentration right from Bitcoin's start.
Mm-hmm.
But like we said, it begs the bigger question. Is this kind of concentration just a Bitcoin origin story thing? Or is it, more widespread in crypto, and how does it compare to the regular economy?
Exactly. And that transition is perfect because that's where the academic paper you shared really comes into play.
Right.
It goes beyond just Satoshi and analyzes the public transaction data across several major cryptocurrencies.
Yeah.
The goal is to map out wealth distribution systematically.
And compare it.
And crucially, compare those patterns to what we see in traditional economies.
Okay, the paper uses some specific tools for this, right? Like the Gini coefficient. Can you break that down for us, like in simple terms?
Sure. Think of the Gini coefficient as basically a score for inequality. It's a number between 0 and 1.
0 and 1.
0 means perfect equality. Everyone has exactly the same amount. 1 means perfect inequality. One person has everything.
Got it. More towards 1 means more unequal.
Exactly. It comes from something called the Lorenz curve, which is just a graph showing, what percentage of the wealth the bottom 10% of people have, the bottom 20%, and so on.
Oh, okay.
A straight diagonal line on that graph is perfect equality. The more the actual curve sags below that line, the more unequal things are, and the higher the Gini number.
Makes sense. And the paper mentioned traditional economies for comparison.
Yeah, it cited Credit Suisse data suggesting the top 1% globally holds about twice the wealth of the bottom 50%. And it used Ireland as an example with a traditional economy Gini around 0.67, which is, fairly unequal.
Okay, so Gini measures the overall spread. What about the Nakamoto index? That sounds very crypto.
It is, and it ties wealth concentration directly to network security. The Nakamoto index is the minimum number of separate people or entities you'd need to control 51% of a cryptocurrency's total supply.
Ah, the 51% attack threshold.
Exactly, because controlling the majority can give you disproportionate power, maybe even let you carry out certain attacks, depending on the consensus mechanism.
Yeah.
So a low Nakamoto index is bad.
Means high concentration.
Right. It means just a handful of entities hold the majority, which signals a potential vulnerability.
Okay, Urani for overall distribution, Nakamoto index for control concentration, and security risk. And the researchers figured this out by digging through all that public blockchain data, even with the anonymity.
Well, pseudo-anonymity, it's a huge data challenge, yeah. They mentioned using techniques to try and cluster addresses that likely belong to the same entity. And while it's not perfect, they felt their methods were good enough to reveal the important trends and how wealth clumps together on these networks.
All right, so after all that digging, what did they find? What's the verdict on wealth distribution across the, 8 cryptos they looked at?
Okay, so this is where it gets really interesting and maybe challenges some assumptions people have about crypto.
Yeah.
The big picture finding. The median Junani value across the cryptocurrencies they studied was 0.71.
0.71. And how does that compare?
It's surprisingly close to the median Gini the paper cited for real-world economies, which was 0.73.
Wait, really? So despite all the ideals about decentralization and, disrupting traditional finance, the average crypto economy they looked at is about as unequal as the average traditional economy.
That seems to be what the data suggests, yes.
Yeah.
It's a pretty significant finding. It pushes back hard on the idea that crypto automatically creates fairer outcomes.
Wow. Okay. So that's the average. What about specific coins? Did they see differences?
Oh, big differences. Take Bitcoin. It actually started in its very early days with extremely high inequality. Makes sense, right? Very few users.
Sure. Low adoption.
But the paper found that over time, as more people got involved, Bitcoin has actually trended towards fair distribution. The Gini has decreased.
Okay, that's positive, I guess.
Relatively speaking. As of their data cutoff in early 2021, it was still pretty concentrated. 0.01% of addresses held over 58% of the Bitcoin. The top 100 addresses held about 13.5%.
Still very top-heavy, then.
Definitely. Its Gianio was around 0.65, which they noted is similar to a country like Australia. So better over time, but still far from equal.
Okay, so Bitcoin trended fairer with adoption. Did things like Litecoin or Bitcoin Cash follow suit?
Not always, and this is where the contrast gets really stark. Look at Dogecoin.
Doge. What about it?
Despite its popularity and increasing adoption, Dogecoin showed the opposite trend. It actually became more concentrated over time.
More concentrated, even with more users.
Yeah. Its Gianni was very high, around 0.82. That's closer to the inequality level cited for the U.S., which was 0.85.
Wow. And the specifics.
Get this. A single user address controlled over 23.5% of all Dogecoin.
A single user. Nearly a quarter of the supply.
And the top 100 addresses held over 64%.
That's way more concentrated than Bitcoin.
Significantly. And the paper explicitly notes this moves towards violating that honest majority assumption we had talked about. A very small group could potentially control things.
Okay, that's worrying. What about others like Litecoin?
Litecoin was sort of in the middle, fairer than Dogecoin, but less fair than Bitcoin. It showed a slight trend towards becoming fairer over time. Bitcoin Cash, having forked from Bitcoin, actually showed increasing concentration after the fork.
Hmm. So lots of variation. And you mentioned Dash was an outlier.
Yeah, Dash really stood out. Its Gini was incredibly low, around 0.28.
0.28. That's much lower than Bitcoin or Doge.
Much lower. In fact, it was lower than any of the real-world economies they used for comparison. The most equal country they cited, Slovakia, was 0.48.
So Dash is more equal than actual countries. Why?
The paper suggests it might be down to Dash's specific design, its masternode system.
Ah, the masternode. You need collateral for those, right?
Exactly. You need to lock up 100,000 Dash to run a masternode and earn rewards. The theory is this incentivizes people who have a lot of Dash to split it up across multiple addresses, to run multiple masternodes and maximize their rewards.
So it encourages spreading the wealth, at least among those participating in the masternode system.
Potentially, yes. It creates a more even distribution, even if it's somewhat artificial, among those actively involved in running the network. And supporting this, Dash also had one of the highest Nakamoto indices, meaning it took more entities to reach that 51% control threshold.
That's fascinating. A specific design choice potentially leading to much lower inequality.
It seems like a plausible explanation, yeah.
Okay, what about the Ethereum ecosystem? Ethereum itself, and then its tokens.
Right. So Ethereum itself had a higher Giannini than Bitcoin initially, meaning more inequality. But like Bitcoin, it was also trending towards fair distribution over time.
Okay.
Its fork, Ethereum Classic, not so much. It showed poorer distribution than both Ethereum and Bitcoin.
But the tokens, you mentioned they were different, ERC20s.
Dramatically different. The paper looked at the top 5 ERC20 tokens by market cap at the time.
Right.
They found extremely high wealth inequality. Gini values very close to 1.
Close to 1, like almost perfect inequality.
Pretty much, and very low Nakamoto indices too, meaning extreme concentration of control, way worse than Bitcoin or Ethereum.
So the tokens built on Ethereum are potentially much more concentrated than Ethereum itself.
Mm-hmm.
And worse than traditional economies too.
Significantly more concentrated, yes. The paper floated some possible reasons, like how many tokens are initially distributed. Often large amounts are pre-mined or held by the founding team.
The initial allocation?
Yeah, or just the dynamics of these specific token ecosystems. Even widely used tokens showed this pattern.
Okay, so it's a really diverse landscape. Bitcoin trending fairer, Dogecoin getting worse, Dash being super equal, and tokens being hyper-concentrated. What factors did this study point to as, like, the main drivers of these differences?
They highlighted a few key things. First, as we saw with Bitcoin and Ethereum, adoption seems to play a role. Generally, more people getting involved tends to lead to fairer distribution over time.
But not always. Like Dogecoin.
Right, it's not a guarantee. Dogecoin's trend shows other factors are at play.
Like market size. Did that matter?
Generally, yes. Market capitalizations seem to correlate with better distribution. Larger cap coins like Bitcoin and Ethereum tended to have lower genus, meaning fairer distribution.
Yep.
But again, Dash throws a wrench in that simple correlation. It wasn't the largest, but it was the most equal.
Which brings us back to its structure.
Exactly. Policy and structure seem really important. Dash's masternode system is the clearest example. But the paper also noticed something interesting with Bitcoin.
Yeah.
They saw temporary drops in Bitcoin's Gini value correlating with the timing of some major consensus-based policy changes, like specific BIPs being implemented.
Huh. Why would a technical update affect wealth distribution?
Well, the suggestion is that these changes might influence how people hold or manage their coins. Maybe they encourage adoption of things like hierarchical deterministic wallets, HD wallets, which can make it look like wealth is spread across more addresses, even if controlled by one entity. Or maybe major events just shift behavior. They also noted a large distribution by Coinbase in late 2018 that seemed to impact Giannini values across several currencies simultaneously.
Interesting. So adoption, size, and definitely the specific rules and design choices of the coin itself.
Those seem to be the key influences identified.
And the paper really hammers home that this concentration isn't just, an academic point. It has real security implications.
Absolutely. This is maybe the most crucial takeaway from a practical standpoint. High concentration, whether you measure it with Gini or low Nakamoto index, directly links to increased security risks, especially for networks that rely on that honest majority idea.
Right. Like, could large holders manipulate the market?
That's a major concern. The paper explicitly mentions the risk of whales, large holders, influencing exchange rates or engaging in manipulative trading. They bring up the speculation around Tether possibly being used to inflate Bitcoin's price back in 2017 as an example of how concentrated power could potentially distort markets.
Okay. And the act of moving large amounts can cause problems too. Whale transactions.
Yes. If a whale sends a huge transaction with a very high fee, it can create incentives for miners or validators to prioritize that transaction above all others.
Causing delays for everyone else.
It could lead to network congestion, drive up average transaction fees, or in some cases, even cause temporary disruptions or forks if validators start competing heavily for that single large fee. The paper mentioned the iFish attack on Ethereum in 2018 as an example where a flood of high-fee transactions really gummed up the network and made it expensive to use for a while.
Right, I remember that. So it impacts usability and cost for regular users?
Yeah.
And coming back to that honest majority risk, which specific coins did the study flag as being most concerning based on their concentration levels?
Based on their analysis, particularly looking at the Nakamoto index and the concentration data, the study specifically called out Dogecoin, Zcash, and Ethereum Classic.
Why them?
Because their findings suggested that fewer than 100 distinct entities potentially controlled over 51% of the wealth or resources they could analyze for those coins.
Fewer than 100
Yeah.
for 51% control.
Yes. Which indicates they were moving towards, or maybe already violating, that assumption that a majority of participants are independent and acting honestly. It signals a heightened security risk compared to networks where control is more spread out.
Okay. So let's kind of bring this all together. We started with Satoshi, this almost mythical figure with $120 billion in Bitcoin. And we talked about how cryptocurrencies were often pitched with these ideals of, economic freedom, decentralization, maybe creating fairer systems than traditional finance.
That was definitely part of the early narrative for many.
Yet, what this research and even the Satoshi story itself seems to show is, well, a much messier reality.
Yeah, it seems that way. While the patterns differ between coins, the overall trend isn't one of radical equality. Wealth distribution in many of these crypto economies, and especially in the token space, often looks surprisingly similar to, or sometimes even more concentrated than, the traditional world.
And Satoshi's massive passive fortune sitting there from day one is kind of the ultimate symbol of that concentration, isn't it?
It really highlights it right at the origin point. It underlines that concentration isn't just about rankings on a rich list.
Right.
It has real, tangible implications for whether these systems achieve their stated goals of decentralization, and maybe more importantly, for the actual security and stability of the networks themselves.
So it really leaves you wondering, doesn't it? Given that crypto wealth often looks so much like the old worlds, and given these concentration risks, what needs to change?
That's the big question.
How might the way cryptocurrencies are designed or governed, or maybe how the community manages them, how might that need to evolve if the goal really is to achieve something more decentralized, more distributed than what we have now?
It's definitely food for thought. How do you build systems that resist this kind of concentration or mitigate its effects? It's a huge challenge going forward.